Welcome to the Robert M. Financial Market Update. It's your host, Robert M. I look at the week's financial news that can be a bit confusing, misleading, and take you off course and help to make it actionable, understandable, and clear. What a week. What a show. Temperatures keep dropping here in Dallas. The rain is a-fallen, which is a blessing as well. We've got 3 great articles. It's a Wall Street Journal sweep this week. We are going to be looking at Mr. Jason Zweig again, one of our favorites. The headline, when interest rates go down, the hucksters spring up. It's a really good one. Next up, these new AI bots will do just about anything for you. Artificial intelligence in your investing. It actually gives an example of a firm doing it. And then in closing, Americans are really, really bullish on stocks. This is by Mr. Gunjan Banerjee, another one of our usuals. And I feel that way too. I'm sensing a lot of bullishness out of all of you guys. But let's start at the top here. When interest rates go down, the hucksters spring up. Subheadline here. An investment advisory firm was promoting guaranteed annual yields of up to 17.1% until our columnist started asking questions. Let's do a bit of definitional work just to set the table. What Mr. Zweig is referencing is that we may very well enter into a period of lower interest rates than we've had in the most immediate past. So as you all know well and good, interest rates have been higher. So whether you are getting a mortgage or seeking to borrow money on a margin loan from your brokerage account, those rates have been higher because the Federal Reserve raised rates as a way to tamp down inflation. Well, it is suspected that we will have lower rates here in the future, and Mr. Zweig is highlighting some of the charlatans that will come in to bridge the gap, to tickle the ears, to ensure that we are going to have whatever we want and more. By way of example, the proxy I like to use when determining where we are in the interest rate environment is the Vanguard Money Market Mutual Fund rate. They call it the 7-day SEC yield. Currently, that money market fund, which is the default position for cash at Vanguard, is 5.24%. That's pretty good. Pretty good, particularly when you consider the last decade of interest rate policy. That's pretty good. But what can happen, and this is what Mr. Zweig is alerting us to, is that if that goes down and then we go look for alternate places of yield, we must be wise as serpents and innocent as doves. Let's get into this article now that we've got the table set. Mr. Zweig said, it has been as easy as rolling out of bed to get a good yield of at least 5%. We've just proven that by looking at the Vanguard website. Yep, 5.24 is what it is today. So investors, he's saying, need to be on their guard against the inevitable rise in come-ons that prey people's craving for high income. And I will say I have experiential knowledge of this, not only for myself. I think I've probably shared this on the podcast before, but I have chased yield in innumerable ways. I didn't think I was chasing yield at the time, but I have. Back in the early days, there were peer-to-peer lending marketplaces, Prosper or Lending Club. I don't know if you've heard of either of these. Effectively, what it was supposed to be a way to broker, cutting out the banks, deposits, people who had money, with borrowers. So instead of borrowing money at 25% from your credit card company, you borrow money at 14%, 15%. These middlemen would disintermediate and ensure that people like me could get a better rate. And so I did this. This was in college at Texas A&M University. I had a Prosper account. And you know what happened? I lost a little bit of money. I was getting yields of like 16 and 17%. And it wasn't because of fraud. It was underwriting risk. Turns out people defaulted on their 15%, 16% yields to me. So I don't see myself as any more superior than any of these people that are falling for these. It's very tempting when you look at a high yield. And we can convince our brains that this is legitimate. And on the other side, I helped a receiver who's a lawyer who took over a Ponzi scheme where high yields were promised to oil and gas investors of the 8, 10, 12, 14% variety. And people believed it because, at the time, you were getting 1% from your bank. And these were guaranteed yields. So let us not think this couldn't happen to us, because I'm telling you, it can. It does. Particularly if rates go down and people start looking around. So what happened? Mr. Zwig, he saw a series of online offerings from an investment advisory firm called Yield Wealth. What a name. This is what it said. They were promoting 10-year term deposits, offering annual yields up to 17.1%. Mr. Zwig puts it in perspective. Right now, the high-yield bond funds yield about 7%. So this person's using verbiage that sounds legitimate. Term deposit. Well, deposit sounds okay. There's FDIC insurance for some of these things. And oh, by the way, this firm, this is a Douglasville, Pennsylvania-based firm, Yield Wealth, they said they were guaranteeing these returns with a $10 million insurance coverage through a network including Lloyd's of London. An online marketing brochure for one of Yield's products, a mega high yield term deposit, what a name, says it offers colossal yields without the risk, adding that any interest you earn is locked in and can't be lost. Are you scared yet? You should be. It says you can lock in 15% APY in perpetuity, adds the brochure, implying that annual percentage yield will be available forever. Zwig says his eyebrows were really twitching. What Zwig said he discovered is that there are no bank accounts. There are no bank accounts, even though the marketing website said there were deposits and you could be insured up to $2 million by the FDIC. So wouldn't you know it? Zwig contacts the firm, and the company took most of the websites offline immediately. In the follow-up, Kenneth Boyle, the firm's chief executive, says, these products were never launched, and Yield Wealth has now been dissolved without ever taking any funds. Okay, he says that there was these marketers who were doing a testing phase. And yet, Mr. Zwig said he found a website that gave testimonials. Carroll, a retired plastic surgeon, invested $3.24 million in a 10-year term deposit yielding 9%. The CEO says, oh, you should just ignore that. Okay, so you kind of get what's going on here. Now, what I find scary is it is actually the exception that someone like Mr. Zwig will do due diligence. Usually, through the use of relational capital, people will simply trust. What means are used? Oftentimes, sadly, it's through the church or through a country club or a fraternal organization. Somehow, someone will engender trust with someone, promise them a high-yield product, and make claims about the guaranteed nature of it. So, and this article goes on and shows in even greater detail. There were further lies. I mean, it was lie after lie after lie after lie. Someone lied about their identity that worked for the company, doubled down on the lie. Mr. Zwig found out that, in fact, this person had been barred from ever working in the securities industry. So just a little bit of due diligence by one man effectively brought this house of cards down. I am telling you, there are innumerable numbers of instances like this where if you do not have your hat on, and I might get a tattoo that says keep your costs low, invest in simple time horizon long. Just put it on my forearm so I can just look at it. Although I don't recommend tattoos. Our official podcast policy is no tattoos. So maybe there's a way we can figure this out. Henna tattoos maybe. But put that on your left forearm so as you put the ink to any deal, you can say, is this correct? Am I following the heuristic I've set up for myself to ensure I don't do something foolish with money? Because it is tempting. Nothing feels easier than a click of a button at 8 or 9 or 10% when you're getting right now 5.24% with a click of a button. Be very wary of anyone promising you greater returns for no extra effort, no extra risk. No extra effort, no extra risk, no way. You remember last week's episode where we enumerated ad nauseum about Morgan Housel's philosophy that the two ways investors get paid are buying something, alpha, that's cheaper than it's worth. You buy $1 for 80 cents. And the other way is being able to persevere through volatility. That's it. Housel was effectively saying there's not a ton of free lunch out there. You have to work for that alpha, that risk-adjusted return, that buying something that's worth $1 for 80 cents. That's actually really hard. So be on your guard, listener. Do not fall prey to these hucksters. And I think a great antidote for this is just invite other people in. Don't do this in isolation. Get yourself an hourly financial advisor or a spouse or both. and let them in on it, even if they're not, quote unquote, by their own admission, finance experts. That's okay. What if they've just got wisdom, intuition? Sometimes that's all you need. You don't need to know anything about money. You just need to know a lot about human nature. So next up, we're talking AI bots. Had a fascinating conversation with a client this week, and it made me think deeper about, well, how does artificial intelligence affect you, the listener, affect me, the practitioner? What do I need to be thinking about? In this headline, these new AI bots will do just about anything for you. Subheadline, artificial intelligence-based assistants are here to take orders and book trips. They don't need any help from humans. This is fascinating. I've been following this for a while, and I think it's going to happen, listener. I don't know that, but I think these agents, basically these, if you're unfamiliar, you're probably familiar with large language models and ChatGPT, and you can ask a question and it gives you an answer. It's all very interesting, but increasingly, this article explains there will be agents that will actually go off and do tasks, act autonomously as a human would, and complete it for you. So they give the example of a dining reservation. This agent will be able to actually call, have a real sounding voice, book it, and make it happen all for you. And increasingly, the restaurant will have an agent. So the agents will actually be talking to each other to book the restaurant. That's kind of, it's already starting to happen. You don't always realize it, but it's already starting to happen. So what about investing? Well, this article takes that head on. It says, imagine a future in which you can get real-time financial guidance on your investment portfolio without waiting for your advisor. That's me. One UK-based startup is helping companies get one step closer to that. So they have a bot they made, Finley AI. It helps financial firms build their own bots. So effectively, some company will come to you and say, hey, please build me a bot. And Finley AI will do it and customize it for whomever, Schwab or Fidelity or Vanguard or anyone else who wants it, JP Morgan. I don't know who they're choosing yet or what they're doing, but what it will be able to do is actually execute your wishes. So purchase, sell securities, set up an insurance policy. All it'll do, you'll have to give it the authority to do these things, just as you would a human agent, but these artificial intelligent agents will be able to effectuate these changes for you if you just set in your preferences. So I think there's incredible opportunity here. Of course, a ton of change that may not be that comfortable for yours truly, but what I see is if this actually works, it'll become incredibly important that you have the right philosophy for these agents. So I know I'm talking like it's the year 2040, but I actually think this is going to happen sooner rather than later. I want you to be equipped. What I want you to be wary of is beware of anyone who purports to have an agent that is going to outperform. Okay, so some of the tried and true rules of the humble rules of arithmetic, as Warren Buffett said, they're not changing. So that cost low, investing simple, time horizon long, all good. What I think could happen is a good agent could help you sell, this is already happening, but do a tax loss harvesting strategy for you that's customized within your brokerage account, which would be good because I think there's some of this direct indexing business I think is way too complicated. I got a great article. I didn't make the show. Not every article makes the show. I had a great friend of the show send me something about direct indexing that was not as bullish on how it's going to help you. But I'm recommending move very slowly on these AI agents. Very slowly. For the restaurants, fine. For travel, fine. For medicine and for investing, I'm not going to want to beta test this one. I'm going to want to let this play out for a couple of years before I give any sort of autonomy to a bot. I think a lot can go wrong. Just so you know, listener, I am regularly testing the intelligence of the bots in the area of personal finance, and they're oftentimes really good, and other times they double down, and they're wrong. So I want to see a long track record of excellence before we say, yeah, here are my parameters. Here's what I believe. Go and do likewise, Mr. Bot. I think that day is coming, but I'm watching. And then in closing, Americans are really, really, really bullish on stocks. This is by Gunjan Banerjee. Individuals are taking a peek at their 401ks and rejoicing. All true. I thought there were some takeaways here that I want to be mindful of. One, Let's look at the data. As of the second quarter, the number of 401k retirement accounts at Fidelity Investments worth at least $1 million reached around 497,000, according to the firm. That's up 31% from a year ago and a record high. So yeah, people are feeling good. U.S. household stock allocations have steadily inched up this year, according to J.P. Morgan, and recently accounted for around 42% of their total financial assets. This is the most on record in data going back to 1952. And investors are still feeling good about the market. It talks about the number of fresh highs the S&P 500 has hit, gives examples of various individuals and how bullish they are because of how well it's done in the past. I think you can already tell what the punchline from yours truly will be. It shows fund flows. This is money that is being put into these funds, and it's significant. So your peers in America think the stock market will keep going up and up and up. There's a quote by Mr. William Borod, a 67-year-old dentist in Springfield, New Jersey. He says, "This melt-up is exactly what any investor should be waiting for." He says, "The most conservative approach is all in all the time." So Dr. William Borod says, all gas, no brakes. Now, there's another gentleman quoted here, Thorne Perkin, who's the president at the Papa Marku Wellner Perkin. It's a multifamily office. Okay, so that always sounds prestigious, like you get a family office, and you get a family office, and you get a family office. My experience is that these shops are not that great based on clients who have been at places like that, but you never know, always exceptions. He says this, Mr. Thorne Perkin, he says, "We're bullish, and to our clients, we say now is an opportune time to invest." Now, RHF listener, what's wrong with Mr. Thorne Perkin's statement? Let's be gracious here in our critique of him. What's Mr. Perkin getting wrong when he says we're bullish, and to our clients we say now is an opportune time to invest? Can you think of what he's missing? Well, if you said it's a form of market timing, I'd say you're right. You're right. Whenever someone comes in and says, it's now, now is the time to invest. This is it. It's lined up. It's good. It's ready. The implication is that previously it wasn't a good time to invest. And maybe in the future it won't be, but now is. And it implies that Mr. Perkin knows something that we don't. There's something proprietary about Papa Marku, Wellner, and Perkin, other than the unique name, that allows them to dictate when the right time to invest is. But listener, we know that no mere mortal holds that knowledge. And those that do, they really can't consistently execute. Right? They say they do, but they really, once you leave the laboratory and enter the real world, they can't consistently execute. Because the ability to know when to invest and when not to invest is just going to mess up our heads. It's going to mess us up. What is more important is just that you do invest. And I advocate for ostrich investing in this particular instance. Just, if it's time to invest, just invest. It's the best time to invest when you're ready to invest. Remember, one of our monikers on the show is strategic mediocrity. So what strategic mediocrity requires, as the Morgan Housel term is, you just ensure that you yourself are in a good place, a stable place, a permanent place. You can execute an investing strategy with permanence. That's the best time to invest, irrespective of all-time highs, irrespective of huge lows. Don't try and play that game. Most of the time, I just see people get paralyzed when they seek to move in and out of the market. Don't do that. What should you do? You should keep those costs low, that investing simple, and that time horizon long, because that's what's going to give you the best shot on your investing journey. Until next week.